Hey everybody, I hope everyone is doing well and had a good day and a good week. And in this video, I want to talk a little bit about momentum and overlap. And it's not a really structured video. I'm kind of just thinking on the fly, but I wanted to share my thoughts. So let's get right into it. The first thing I want to talk about, I want to compare the two breakouts on the screen right here. And you'll notice we have some similarities. So this one is from September the 15th, and this is from September the 11th. And in both cases, we have a gap up going into the day. We have a small 3 or 4 bar trading range open and a 3 bar micro channel for the bulls. Looking at these side by side, it's pretty apparent which one is more strong, but I want to talk a little bit about that. And before I do, let me see if I actually want to pull up. I made a few slides about this, and I think it'd be good to share. Before I get into the charts, I want to talk a little bit about this context flowchart, and some of you might recognize this from Brad. I got this idea from Brad, and he used to share it in his end of day reviews. And I think it's a good prerequisite, I guess, before getting into the examples on the chart. So this is an overview. It's a very simple flowchart to help determine context. And you can see it's a binary decision tree. So at the top, the question is, what's the context? Market is it's always either in a trend or a trading range. And from there, you keep the binary decisions going. So context, trend, or trading range. If it's a trend, is it a breakout? Is it a channel? If it's a breakout, is it strong? Is it weak? If it's a channel, is it tight or broad? If it's a trading range, is it tight or broad? And you have to be able to identify and classify the context because you trade each scenario and each phase of the market cycle differently. And the path I want to focus on for this video, as you can see here, that's highlighted is breakouts, which are either strong or weak. Also, one more point about this flowchart as a whole. And this has to do with anything. I have a belief that we think in pictures, and it's almost like there's a screen running in the middle of your head in your mind. And even if you're sitting here looking at your computer, you can see your computer with your eyes. But if I start to mention a bull breakout or a high one at the top of a trading range or anything like that, you get a mental picture in your mind. And if you don't get a mental picture in your mind, there's confusion. And that's a sign that you could spend more time studying the topic that you don't have an image of. There's confusion. The goal is to have an image for every one of these answers, basically. What's the context, trend or trading range? We go down the line, and you have a mental image for what a strong breakout looks like, what a weak breakout looks like, what a tight channel looks like, a broad channel. Each and everything, you should have a mental image for it. And again, at the end of each decision tree, at the end of I think it's called the terminal node, you get the actual action. So if it's a strong breakout, just buy the close, sell the close, enter at the market. If it's a weak breakout, enter on a pullback. Most breakouts get second legs, even if they're weak. So a weak breakout doesn't necessarily mean it's not going to get a second leg. It just means it might get a deeper pullback and a delayed second leg. So rather than buying the close, maybe there's not as much momentum, so you wait to enter on a pullback. So that's what I want to focus on in this video. Okay, so with that binary decision tree in mind, let's get into the examples. The first one I want to talk about is the weak breakout. Why is this breakout weak? The breakout on the left. it's a 3-bar micro channel after a gap up. Why is this weak? And it's good to compare it. So why is it weak compared to this one? The two things that stand out to me are the overlap between the bars and the size of the bars getting much smaller. So look at this bar overlapping the prior bar by about 80%, maybe more. Same with the next bar. And then the next bar maybe overlaps the prior bar by 50%. Overlap is it's a warning, it's an indication that this is a channel on a smaller time frame. So if we looked at a smaller time frame chart, which we will, we're going to see that this is a channel. Market rallied, pulled back, rallied to a new high, pulled back, rallied to a new high, and this is now a wedge on a smaller time frame. Compare that to the strong breakout on the right. The first bar has overlap, but what stands out to me in this one is that the bars are more uniform in size. They're not obviously getting smaller, and there's very little overlap between this bull breakout bar and the prior bar, and this breakout bar and the prior bar. Because of that, even though these are both 3-bar bull micro channels, the expectation is different, and that means the way you're going to trade it is going to be different. Let's pull up the flowchart one more time. Context, it's a trend, it's a breakout. The first one is weak, and so the one on the left is weak, the one on the right is strong. So how do we deal with each one? Weak breakout, so we're expecting a pullback rather than buying the close. Better to look to enter on a pullback. For the strong breakout, it's okay to just buy the close. So if we run through what happens here, bears get a trend bar, strong enough bar for a second leg, and it's possible that maybe we find support at the 50% pullback. So big bear breakout bar followed by a much smaller bar overlapping the prior bar. The downside here is probably limited. Remember, it's a weak or weaker breakout, but that doesn't mean it's not going to get a second leg. It just means the expectation is different from a strong breakout. So maybe we don't get as strong of a trend, but we still get a channel. So bull breakout, we start to pull back 50%. Bears should get at least an attempt at a second leg down. So maybe don't buy here, wait for that second attempt and buy the second leg attempt. Bull reversal bar, attempt at a second leg down. We have a high 1, and now this is a low 1 for the bears, but the context, not very good. 50% pullback after the rally. So now the rally, the weak breakout, has had its pullback. 50% pullback, market's stalling here. The equation is better for the bulls than the bears because a second leg up is likely. So the probability favors that we'll test the high before the low. And at 1-to-1, if a bear enters here and puts their stop above and target below, and if a bull enters here, stop below, target above, the bull has better probability of reaching their target before their stop is hit. It isn't until the pullback reaches about 2/3 of the prior leg that it becomes more 50-50, but in this case, still at least a 60% probability we get to a new high before running the stops. So buying here is reasonable. We have a weak breakout, a pullback, you want to look to enter on the pullback and capture the second leg. It's a channel, so we can see weak breakout, 50% pullback, second leg up, but we know it's a channel, and in a channel, bulls are going to take profits at the highs and continue to buy pullbacks. So buying here, really not ideal. This is more of the profit-taking area, and you can see the hesitation there. Now, if we compare that to the breakout on the right, the strong breakout, you can just buy the close here because it's likely the bulls are going to get a measured move up. And if you bought the close, follow through, smaller bar, but still nothing to sell. A little overlap here. This is a breakout pullback on a smaller time frame. Probably buyers below. First bear bar in a lot of bars. Traders will buy it. Bad follow through for the bears. Now it's a couple legs down. 1, 2. Traders will buy here. Second leg up, likely, and possibly a measured move based on the height of the breakout. Breakout to a new high, but compare that to this. Bull breakout to a new high, but breaking far above the bars to the left and closing above all the bars to the left. And probably, maybe half the bar, maybe a little less, is above the breakout point. But over here, hardly any of this bull breakout is actually above the bars to the left. We still might pause here and hesitate, but the probability is that the bulls will get another leg up. Maybe we test this breakout point, but this becomes support. Bar's getting smaller, so that's kind of like over here. Waning momentum, big bar, even smaller bar might pull back. Same thing here, might have to pull back, but this looks like a strong bull trend. So pull back, maybe shallow. You can see market testing that breakout point, micro double bottom, reversing back up, reasonable to buy. Bad low 1 for the bears, which means good fade for the bulls. Bulls will buy below that bull bar by the close of this bear bar. It's a second leg attempt against a strong trend. And then the bulls get their target. So I want to look at these one more time and compare the smaller time frame charts to each other. And we can see what happened here. So the bulls ended up getting a pretty strong trend. Finally, a 3 or 4 bar micro channel. That's enough to convert the market from a strong trend into a trading range. We've had several legs up, so we might start to go sideways here. Compare that to this. 1, 2, 3 legs up. Again, this breakout bar heavily overlapping the breakout point, not breaking far above, not getting strong follow through. Over here, breakout, strong follow through, smaller bar, but bar closing on its high compared to this weak follow through bar. And you can see the upside was much more limited for the weak breakout on the left, and we ended up getting a trading range with a much deeper pullback and actually a reversal. This is a lower high, major trend reversal. Bull trend, trend line break, weak retest, lower high, major reversal. That didn't happen over here. This strong spiking channel evolved into a trading range, but the bears never really got much out of it. It's more sideways than down. And all of that is hinted in the initial breakout. So one more time before we look at the smaller time frame charts. 3 bar micro channel, but the body is getting smaller and the bars are heavily overlapping one another. That's a channel on a smaller time frame. We're going to look at that. Compared to over here, uniformity, so uniform size bars, bars closing on their highs, and relatively small overlap. So let's look at the weak breakout first. I like the 100-second chart. I got that from Ali because 3 100-second chart bars make up 1 5-minute bar. It's kind of like how the 5-minute chart, 3 5-minute bars make up a 15-minute chart bar. I just like the multiple of 3 comparison. So here's the rally. This is the 5-minute chart on the left, 100-second chart on the right. If you look at the chart on the right, there's a couple things I want to talk about. First thing, let's talk about the breakout first. The green rectangle is showing the exact same period of time. Remember, every 3 bars on the 100-second chart make up 1 bar on the 5-minute chart. So this bull bar, 1, 2, 3, corresponds to this first bull breakout bar on the 5-minute. 1, 2, 3, 4, 5, 6, 7, 8, 9. These 9 bars are the same as these 3 bars in the breakout. So look at the characteristics of the breakout. First 2 bars are okay. First one overlaps the prior bar by a lot. This is a good breakout bar, but it got weak follow through. And then the next bar looks like an inside bar. It did not break out above the prior bar. And then look here, maybe half the bar overlapping the prior bar, maybe 90% overlap, doji overlap, outside bar overlap, the next bar still overlapping. You can count 3 legs up, 1, pull back, 2, pull back, 3. And if you think about if you're fading this bull breakout, bears got trapped down here for sure. Selling above this bear bar, they're trapped. But what about selling here? If a bear sold above this bull bar, this is actually a bear bar, the one closing below its midpoint. If a bear sells here, maybe they're trapped on the next bar, but they had 4 bars, 3 or 4 bars to exit at break even. And if a bear faded this doji, they sold above this bar, maybe they're slightly trapped, but they're not panicking out because they know it's 3 pushes up. There's probably going to be a pullback. So the bears are not getting trapped with limit orders here. They're disappointed, and I suspect the limit order bears that sold here are disappointed by their follow through. So I suspect they gave up and were looking to sell higher, which contributed to this 2 bar breakout here. But then they sell again. And after 3 legs, the bulls are exhausted, the bears get stronger, they get the strong reversal. And then as a big picture, the chart on the right is a broad channel. It's a broad bull channel. So the bulls, you're getting higher highs and higher lows, but the pullbacks are deep, and it's probably better to exit and not hold through these pullbacks. They're deep. They might even be always in short. 3 bar micro channel, second leg down likely. So better to just exit and look to buy lower until we finally reach support. Again, this is where I was saying the bears did get trapped. We're testing support, and that's where we reverse back up. But look at this rally. It's all within this sell-off. So big down, big up. How much is actually breaking out? Not all that much. It's a channel phase, sellers at the new high. We pull back again about 50%. This one, about 50%. The next rally pulled back about 50%. So you don't get 50% pullbacks in strong trends. 50% pullbacks happen in channels and in trading ranges. Now let's look at the strong breakout example. So again, I want to start by, let's look at the breakout first. First 3 bars here, and then here. So here's the breakout on the 100-second chart. Now imagine you're a bear and you're fading breakouts. You're fading above bars. You're selling above bars. You sell here, you get trapped. Did you ever get a chance to exit at break even? No, you got a high or low. You sell here or here, you're trapped on this breakout. It got follow through. Were you able to exit at break even? No. You sell here or here, another bull breakout. Were you able to get out at break even? No, again. So it is 3 pushes. 1, pull back, 2, pause, 3. But it's much tighter than the other one. And I'm going to compare the 200-second charts as well. But that's what's happening when we drill down to the lower time frame in this 5-minute 3-bar micro channel. And we already looked at what the outcome was. We got a strong bull trend, spiking tight channel. So let's look at the 100-second chart for the strong breakout versus the 100-second chart of the weak breakout. So what's the main difference here? To me, the main difference is overlap. How much each bar is actually overlapping the prior bar. The breakout bars themselves. Bull breakout bar closing near its high. Little overlap with the prior bar. Same here. Same here. And even this one, little overlap. But over here, the bulls had one decent bar with little overlap with the bar before. Heavily overlapped the prior bar. Weak breakout bar closing below its midpoint, inside bar, and lots of small bars with lots of overlap. If we think about the logic, why is a weaker breakout, why do we consider overlap weak? It's the logic of trapped traders. You think about the bears fading the breakout. This is why it's important to put yourself in the shoes of the opposite side. Put yourself in the shoes of a bear during a bull breakout. One thing that Brad used to say in his end-of-day reviews, he would ask himself, how screwed are the opposite traders? In a bull breakout, how screwed are the bears? We already talked about it, but just one more time to go through it. Remember, if a bear is fading above, selling above bars, they're fading breakouts. They're trapped here, but if they start selling here, they're disappointed with their entry bar, they have a chance to exit break even. If they sell above here or here, they're disappointed with the follow through, they have plenty of time to exit at break even. They sell here, disappointed, but plenty of opportunities to exit at break even. 1, pullback, 2, pullback, 3. Bulls exhausted, bears getting stronger, and we got that pullback. It's still a minor reversal. This is still a very tight bull channel, even though there's 3 pushes. So the expectation is a minor reversal and then trend resumption. That's exactly what we got. But we have to be prepared for the deeper pullback when the breakout is weak. So again, compare that to this. It's 3 pushes, 1, 2, 3. But how screwed are the bears in the example on the right? They're much more screwed. They're much more trapped than the bears on the left. Bears selling anywhere are not making money. Even limit order bears, they're not making money. That's a sign of a strong bull breakout. Leads to a sideways pullback, more up, sideways pullback, more up. But over here, when the bears are not all that trapped, you're going to get much deeper pullbacks. So that's going to be it for this video. Again, it was kind of spontaneous, not really structured, so I hope it made sense and I hope you were able to follow me. I hope the information I shared was valuable. And that's going to be it. So thanks everybody for watching, and I hope everyone has a great weekend.